Are we looking at just another fragile, hyped-up tech bubble, or are we actually standing at the base of the most significant industrial build-out of our generation? Welcome to The Explainer. Today we're cutting right through the noise to break down exactly why investors need to totally rethink their approach to technology and AI stocks as we head into 2026. Look, given all the wild market hype lately, bubble fears are entirely valid. You're definitely not crazy for thinking it. But the data? The data is telling us a completely different story. It shows a massive, tangible industrial build-out. We're moving way past chatbots here. We're entering an era of heavy physical infrastructure. Think concrete, steel, and fiber optics that is fundamentally reshaping global trade, energy consumption, and long-term wealth creation. So here's our roadmap for today. We'll start with boom, bubble, or build-out, then look at the trillion-dollar infrastructure, break down AI hardware versus software, cover investing safely with AI ETFs, and finally wrap up with building wealth with DCA. Let's jump right into section 1. Boom, bubble, or build-out. Time to deconstruct this 2026 market. Just look at this staggering number, $1.6 trillion. According to baseline supply-side modeling from the Goldman Sachs Global Institute, that is the projected annual capital expenditure for AI by 2031. And to put that into perspective, this isn't just speculative trading or inflated stock market valuations. That is hard, cold cash being deployed to build massive data centers, buy physical servers, and lay literally miles of networking cable. It's a fundamental shift in capital allocation, completely grounded in concrete financial commitments. That brings us perfectly to section 2, the trillion-dollar infrastructure and the actual physical reality of AI. You know, it's easy to think of AI as just a software concept floating in the cloud, but it's a very heavy physical reality. Check this out. Data center power demand is projected by the International Energy Agency to roughly double, from 485 terawatt hours in 2025 to a massive 950 terawatt hours by 2030. AI requires specialized, incredibly high-density server racks and advanced cooling systems. So really, it's fundamentally an energy and hardware story just as much as it's a technology story. And if you want more proof that this is a tangible, cross-border infrastructure boom, take a look at this macroeconomic data from Emirates NBD Research. The current trajectory pushes global semiconductor sales to nearly $1 trillion by the end of 2026. This is reshaping global commerce as we speak, with AI-related goods driving a massive chunk of our current merchandise trade expansion. What we're looking at is an infrastructure build-out creating an absolute supercycle of demand for the semiconductor industry. To put some familiar faces to these wild numbers, we're seeing historic capital reallocation across the board. Amazon? They're executing a mind-bending $125 billion capital investment cycle just to secure their cloud dominance. SpaceX managed to build their Colossus data center, which houses an incredible 220,000 GPUs, by the way, in just 120 days. And sovereign wealth is making moves too. Saudi Arabia's Hamayim initiative is targeting 6.6 gigawatts of capacity by 2034. Guys, this is what a true industrial build-out looks like in real time. All right, let's move on to section 3, AI hardware versus AI software. How do we navigate this ecosystem? By dividing the market into the hardware engine and the software applications, we can create a really clear mental filing cabinet for ourselves. First, you've got the hardware layer, the picks and shovels, right? These are companies like Nvidia, Broadcom, and AMD that are supplying the GPUs, the custom silicon, and the data center networking. Then, on the flip side, you have the software layer. Companies like Microsoft, Alphabet, and Palantir. They're embedding AI into enterprise workflows, search engines, and cloud platforms to generate that sweet, recurring subscription revenue. Understanding this distinction is absolutely vital for balancing your portfolio in 2026. Now, tucked inside that software layer is a totally fascinating wildcard, biotech. AI is actively transforming the incredibly costly world of drug discovery, literally shrinking a multi-billion-dollar process from a decade down to mere months. You've got companies like Recursion Pharmaceuticals using AI-driven automated labs to run millions of experiments weekly, while Moderna is out there leveraging AI for mRNA development. The line between tech and biology is blurring fast, and it's creating a massive long-term growth opportunity. Which brings us to section 4, investing safely with AI ETFs. Let's look at the beginner's playbook. Look, rather than gambling on trying to pick the definitive hardware or software winner, which is incredibly risky, AI exchange-traded funds offer a highly efficient, diversified way to capture that long-term upside. An ETF just bundles the ecosystem into one tradable basket. For example, the Global X AI and Tech ETF gives you broad exposure. The iShares Future AI and Tech ETF captures both developed and emerging markets, and the Robo Global Index targets pure automation. Basically, you get to own the whole buildout in one single trade, which drastically reduces your exposure if just one company happens to underperform. Finally, Section 5, Building Wealth with DCA, time to master the market. So, dollar cost averaging, or DCA, acts as a crucial pressure release valve for the high volatility that's just inherent to AI equities. Because AI stocks swing so wildly on news cycles or quarterly earnings, trying to time the market is almost always a losing game. DCA takes all the emotion out of it. You just allocate a fixed amount of capital on a set schedule completely regardless of market conditions. When prices are high, you're buying fewer shares. When prices dip, you automatically buy more. It mathematically smooths out your cost basis over time and completely removes that paralyzing fear of buying at the wrong time. Executing this is actually super straightforward. It just requires 3 disciplined steps. Step 1, choose your diversified vehicle, like one of those broad AI ETFs we just talked about. Step 2, automate the transfer from your bank to your brokerage so the whole allocation process becomes completely invisible to you. And step 3, exercise patience over adrenaline. Remember, this AI supercycle is a multi-decade infrastructure build-out. It is not a quick short-term trade. I absolutely love this quote from our sources. Treat your investments like a slow-cooked meal, not a TikTok trend. Successful long-term investing is exactly that. The market consistently rewards the people who can zoom out, recognize the fundamental trillion-dollar infrastructure being built globally right now, and just steadily allocate capital over time. Let the giant tech companies fight over who builds the fastest GPU. Your job is simply to own the basket and let compounding do the heavy lifting for you. The literal infrastructure is being poured, electricity grids are expanding, and capital is flowing at a scale we literally haven't seen in a century. By understanding that hardware-software divide and by leveraging the disciplined automation of DCA into AI ETFs, you are putting yourself in the perfect position for the long game. The blueprint is right here in front of us, so the only question left is, are you going to be a spectator to the greatest wealth creation event of our generation, or are you stepping up to be an active participant?